Hello, it's Tim Offer here from Oakleigh Investment Management. I'm again here with Akhil Patel, one of my co-investment committee members. We're halfway through the third quarter of 2026. He's flying by, and we're just going to do, as we do, another little quick snapshot on where we're at with the 18.6 strategic investment portfolio and the markets generally. This meeting, we had a few questions that came in on social, so we just sort of cherry picked a couple of those. So we might do a quick portfolio fly through, and then maybe I'll throw a few questions at Akhil and just talk about how we're seeing things and answer a few questions there. So in terms of how the quarter's progressing with the portfolio, the 18.6 is roughly flat to down 1%. Now that's against a stronger global and Aussie market. We've been sitting on pretty aggressive cash weightings, and we're focused on infrastructure, which has been something of a laggard this quarter, with cyclicals and tech really bouncing, in particular last 4 weeks. Miners and banks all bounced pretty hard off some recent lows in Australia, and obviously tech's had a bit of a bounce out of some lows in July and around, I guess, maybe that hedge fund liquidation, which we might want to touch on a little bit more later on. In terms of performers, best performer so far this quarter is actually Cochlear, which has been a new addition to the portfolio. We've also had some tailwinds from some European and FTSE exposure. We have, during the quarter so far, started to rebuild some market exposure, and we certainly are still looking for opportunities as they come along. But I would say at the moment, things are a little bit of slim pickings, and we're being quite selective with what we're buying and accumulating. But we are still prepared to put capital into the market. I don't expect that we're going to go fully invested at this stage, late stage in the cycle, but we are still looking. We're certainly still watching some of the late cycle sectors like gold and copper, which we have certainly been in the past, but currently largely on the sidelines. Just waiting for some clear direction really there. There's been certainly a lot of volatility in both those sectors and a lot of swings. Now, that could be the signs of some bottoming and accumulation, but it could also be some long-term distribution. So we're really just waiting for, I guess, a little bit more clarity there before we invest or commit investor capital. And look, the other thing that we're continually trying to do is focus on exiting underperformers in the portfolio where appropriate. So we've done a little bit of that around the edges as well. So there's a brief snapshot. I picked a couple of questions, Akhil, or maybe you can kind of tie the question with what you're seeing in the world and perhaps what we're doing in the portfolio with that. Look, very topical. We've talked about it probably every meeting or certainly every video to some extent. The question is, will AI change the cycle this time around? And when the question's asked, this question's really around the real estate and banking cycle.
Common question, common view. I mean, I think those who've heard me speak before know that the answer, of course, is no. In fact, the AI part of it is the final kind of mania of this cycle, just as, you know, the railway mania was the final part of the cycle in the 1840s and the 1850s in the US, 1860s in the US, etc. So this is all part of how things work. Ultimately, AI is a real estate play. It's extremely land intensive. Sites are not available in all locations. They're quite controversial, require a lot of planning, grid connections, and so on. So scarce locations, ultimately these things the land is going to take is going to get quite expensive. It's going to be quite difficult to build on, and it's probably going to absorb via rents of computing capacity. It's going to absorb the lion's share of the returns of these things. And in fact, I think this is where what is going on in the mania phase interacts with potentially the peak of the cycle, in the sense that there's so much overbuilding, shall we say, of data centers. And I say overbuilding because everyone's at it. Everyone is maybe building more than they actually need because it takes so long to get some of these centres online. And the return on investment is being actively questioned by a lot of players in the stock market. And potentially, if it's all going to renting capacity, there's not much return on investment. What then justifies the exorbitant valuations of these AI or AI adjacent companies? So it's definitely something to watch for, and it's something that, you know, with our relatively conservative positioning in the portfolio, I think we're prepared for some difficulties. And in fact, during the sort of market turmoil of June and July related to the hedge fund liquidation situational awareness run by a 24-year-old richly named Leopold Aschenbrenner. It's a fantastic kind of story, makes for great headlines. And that was clearly related to concerns around the potential returns that you're getting from all this capital investment, which led to a bit of a sell-off in AI related stocks, which then exposed people who had over leveraged and over concentrated in that trade. Situational awareness was a hedge fund that had done that. It had to liquidate many of its positions. That added to the selling pressure. So it's a bit of a warning sign for investors, even though the markets now appear to be rebounding. It's a bit of a warning sign that the AI side of things is very much linked to the last stage of the current real estate and banking cycle.
Yeah, I think that's really important, especially probably the key there is the leverage. Like I think the leverage at all sort of levels, whether it's household levels or margin lending or leverage in ETFs or even national debt leverage, like it's building up in the background pretty aggressively, and things like that brings to light. Obviously that was one hedge fund, but I think broadly overall, if you look at the data, like hedge fund leverage is certainly right up there. So the leverage is there. At this point, I guess it's really probably okay until it's not, in a sense. But the danger is in the leverage itself, really. So I mean, that probably, I guess, one of the other questions, there's a little bit to it and long-winded, but if I can kind of summarize it, talking about some of the risks and leverage of debt, inflation, rising yields and political instability, potentially land price peaking in the US and a slowdown there, and the concentration in AI for the investment boom that's clearly going on, and how should we think about protecting their capital or investor capital? And are we entering a period where the biggest risk is not really one of those factors individually, but the convergence, I guess, of all of that reinforcing one another? I might let you answer that, but I guess, rising yields, I think, potentially is the center of the circle in all this, whether it's, it's linked to inflation and the debts that are building up in the system, and then, pressure around political stability. I think you can probably tie all that together. I think, be interested in your thoughts on that, because I think it's quite a good question, tying that back, I guess, probably to the land cycle.
I mean, it's a great question, great observations. Indeed, the convergence of all of these factors is a massive risk to the system. The only thing I'd say is don't overcomplicate it. We are stock investors. We kind of basically know what we need to know, which is the price of our stocks going up or down. And if there is convergence, and there are risks that will materialize in a major sort of downturn in the stock market, and also a downturn in the property market. Whether it's by a simple cause or a more complicated cause, I suppose it doesn't really matter. I think you've highlighted the key point in what you've just said. You've pointed out there is leverage building up in the system, and we have a bit of a drawdown. You start to see some of that exposed. We got an orderly sell-off this time. Maybe the next time it will be a bit more disorderly, because rather than a company being able to sell its assets to other investors who want to buy, in other words, the public equity in some very well-regarded and highly valued stocks, it might be they needing to sell things that other people don't want to buy, which leads to a much stronger fall in prices, which then induces banks to demand further capital or make good on margin loans, which might affect the banks, which then has implications in the interbanking market, and you can see how things spread out. So there is all these implications in what's happening, and you have to be wary, and it is the product of lots of different factors. I think the point you made about rising yields is very important, because at some point the cost of finance can only go so high before some of these, whether it be capital expenditure in AI, whether it be government debt, whether it be other corporate debt, whether it be people who are struggling to make ends meet by borrowing from the credit card companies and so on, and facing rising debt bills. At some point there has to be a level at which the economy cannot take it any longer, and so we are watching very closely what's happening in the bond markets, and particularly the US Treasury market, and it does look like there is upward pressure on yields, something that the US government is trying to manage. You saw the intervention by the US Treasury selling euros or euro ECB bonds to kind of help support the yen. It was kind of an indirect way of doing it, because they didn't want the Japanese government selling US government bonds, which would then add pressure, as I've described. So yes, at the center of it will be this sort of rising debt and rising yields. All the complicating factors, of course, pay attention, but don't kind of make it too complicated for yourself. Just be positioned conservatively. Know where your stops are if you're talking about your own portfolio. This is certainly how we're approaching it in the 18.6 portfolio. We're prepared to go into cash. Of course, if the markets rally, we're prepared to go back into the markets. I think that's exactly right, because no one can really time the peak to perfection. You have to be prepared for your expectations to be slightly altered by events and so on. It doesn't invalidate the overall thesis, but timing, of course, is a different thing. So I think that would be my kind of suggestion to that question.
Yeah, no, that's great. Okay, fantastic. Well, I think that ties back with the way the portfolio has been positioned. We're still selectively and actively looking at things, and we are chipping away, buying opportunities that we like, but by and large at this moment, just where we are in the cycle on the market, we're sitting on we're looking at it with through a lens of capital preservation to a large extent, kind of dancing close to the door, but trying to keep dancing for now. So that's probably, I think that's great.
Well put.
I think that gives a little snapshot of how we're seeing things for now, and hopefully there's some of those questions have been duly answered. Fantastic. All right, I might leave it there. Akil, appreciate your time as always. Look, if anyone listening wants some more information, they can find us at oakleighfs.com. Thank you.